Hi everyone, good evening. क्या हाल चाल है सबके? I hope everyone is safe and doing good. I, Yash Tugar, founder of Crealth Research and Educare, I welcome you all to another great webinar on a Sunday evening. I hope everyone had a great festive season last week. Of course, that's why we took a 1 week holiday because everyone was enjoying their festive season. But we are back today with another great webinar, and today once again there will be some great learnings. There will be some great wisdom as well as knowledge sharing. And today again we have a great young speaker with us. Okay. So before we start, just a quick yes on the chat box if my voice is clearly visible, audible to everyone. Just a quick yes on the chat box if the voice is clearly audible. Perfect. Great. Thank you so much. So as we start every webinar, I always try to give a life learning to everyone so that you can implement it in your life and learn a lot from that. Okay. So today's life learning is you should give proper attention to the most important 4 things in your life. Okay, that is your family, that's your friends, that is your health, and of course your wealth, right? So these are the 4 important things where usually we don't give a lot of attention, where we don't give a lot of focus usually, and that's why it keeps on deteriorating, right? So be it your stock market portfolio, or be it your wealth, or be it your health, if you don't give proper attention, one day it will deteriorate and you won't be able to, and you will regret it later on that why didn't I put my attention earlier, right? So this is a very, very important learning which I find, this is a common mistake which I find in a lot of people where they don't give proper attention to their health. Maybe they're not eating properly, they're not eating right things. The same way it happens with your portfolio. If you're not reviewing your portfolio on a regular basis, if you're not entering or exiting the stocks, which you should, of course I'm not telling you should do it every day, but you should review it once a month, once a quarter, so that you can exit from the stocks maybe which are not performing and you can enter in the new stocks which are doing good, right? So write I pledge on the chat box if you feel that this is important, and from today everyone should focus on their attention on definitely on their health, on their family, friends, as well as their portfolio, which is very, very important in the market, right? So I'm getting a lot of I pledges. Thank you so much. I hope everyone agrees with this. Okay. So now the time has come to introduce today's speaker, who is a young guy, a young passionate investor. Keval Ashar is the speaker with us today. Keval, how are you doing? I'll just unmute you so that you can start speaking. Yeah, Keval, you can just unmute yourself and speak.
Hi, am I audible?
Yeah, you're audible.
Hi, thank you for the opportunity. Thank you for inviting. Yes.
Perfect. So great. So just I'll give a brief introduction about Keval. Keval is a 21-year-old passionate investor who has been there in the market for the last 5 years. He has been doing some great work in terms of educating people on different fundamental parameters, on educating people on Twitter, on different platforms. And he has been sharing some great knowledge ideas where he has identified some multi-baggers. Today also he'll be sharing a great topic he has brought up, that is investing in equities the private equity way. So that I found it, when I had a talk with Keval first time, I found it very fascinating. And I'm very, very excited also to listen to Keval's presentation, where he'll be speaking how, what is the thought process which private equity players, which you can apply definitely in the equity markets, and how he does it through practical examples. He has mentioned a lot of practical examples in his PPT. So I'm really excited. I think all the users are definitely there. So Keval, a warm welcome to today's webinar. Just some quick remarks from you before I tell you to share your story.
Yeah, thank you, Yes, Bhaiya, for inviting. It's a great opportunity to connect with everyone over here. I have started investing in equities like 5 years ago, I guess, but the journey of savings was long ago. So yes.
Great. So Keval, I suppose this is your first webinar, and I think you told me that, of course, I'm very excited. So the same way we are also there. And of course, Keval, as you're there at the age of 21, and at this age, usually people go to college, they try to go out to parties and all, but you are there who is investing in equities at such a young age, educating people and to do that in the same way, and maybe motivating your friends and other young members. So how did you get this motivation of starting taking stock markets as a as a career opportunity and pursuing it from such a young age of, I think, 16 you started, right? Just get us to that journey in a very candid way so that the users also get to know your journey, and plus the young ones who are there who have joined us get motivated to that I want to start like Keval, and I also want to build my wealth at an early age.
Sure. The journey of savings actually started at the age of 13. So if I'll tell you, I used to get this small presents in Diwali and all the festivals, right? So we all get small presents from our grandfather, grandparents, and everyone. So I used to just deposit them. So I'd opened a savings account in a bank at the age of 13. So I used to go to the bank and deposit all my savings, all the gifts I used to receive during Diwali and all the festivals. So the journey started like that. So I used to go to the bank, deposit, and the bank manager used to tell me, so that like you are the youngest person who's coming to the bank, who has an account, and who's depositing money or something like that. So that intrigued me. So yes, it started like that. At the age of 16, I was in hostel for 2 years. So during my 11th and 12th. So I had all the time in the world at the age of 16 and 17, right? So equities was something which fascinated me, capital markets in general. So I started reading about that. I read a few books. I used to read Economic Times daily. Like as I told, I had all the time in the world, so I had nothing to do much to do because I was in hostel. So I used to read Economic Times. I used to go through some books. Like started with One Upon Wall Street. Though didn't understand most of things in that at that age, but yes. So that was the starting point. Then the main journey started when I went to Bombay. So I remember one day I met my Masa. I went to my Masa's place, and he had a fund manager coming to his place. So he made me sit. Like he's like, sit over here and sit with me. So this fund manager was explaining some things to my Masa. So he's like, this company is this stocks we should buy. You'll make this much profit and all this. So it sounded very intriguing to me. So like no one talks to a teenager with this passion, right? So my Masa was one who used to discuss with me all these things. So this intrigued me, and this made me go deep into equities, into capital markets. So that was the starting point, and then the journey began.
Great, Keval. So I think that's a great starting which you did, and of course, at the beginning, if there's someone in a family who tries to support and who gives you the right guidance, that is that's the turning point. I believe that happens in every young chap who gets to invest in the markets. So, Keval, once you met your Masa and you started investing in markets, or maybe you thought I should pursue markets as a career, or maybe investing full time. So, of course, a lot of family members will be there who must have told you that no, Keval, stock market is a place which is gambling, which is very risky. At such a young age, you should not go over there. It's a place where a lot of experienced people are there. So how do you convince them? Because this is one question I think all the youngsters have to face, and even I had to face, and I still face. My mom still tells me, "Ki beta, thoda dhyan se." So how did you go through that, and just tell us in a very candid way, so that the people, youngsters which are watching, even the parents who are watching, will get to see that no, success can be achieved if you have the right discipline and the right knowledge.
Definitely. So being from a Gujarati family, so many of my relatives and like far relatives were involved in markets. So they knew about the markets, though they knew the risks also in the market. So of course, like all the family members, they were like, it's quite dangerous place. It's quite risky place to invest in. Actually, my parents wished that the first company which I actually bought into, I would fail miserably into that. So if I fail, then I would not go ahead. Like if I lose my money in the first company which I buy, then I wouldn't go ahead, right? So then I would go into some other career. I would think of something else. But yeah. So that was the thing. Even of course, my grandmom and everyone's they were quite like worried. Like it's quite risky. So if one doesn't invest properly, if one doesn't have a proper research, if one doesn't know much about the markets, and if they invest like without knowing anything, then it's very risky. So it's very helpful. It's very important to have a study before investing. That's what I believe.
For sure. Great. So I think, of course, as you told, that studying is very important, having the right temperament and the right knowledge.
Yeah, so temperament and discipline is very important. So patience, temperament, discipline, very important for long-term investing.
True. Great. So, Keval, before give you the opportunity to start with the presentation, I have one or two, maybe two more questions for you. One question I think which is very, very relevant again for youngsters is, once you started your investing journey, of course, there would have been a lot of ups and downs. You would have seen 2017's bull market in small mid caps, and then 3 years of a really flat small mid cap. Even the markets fell only the large caps like Nifty was rising. So how did you cope up with that, and how did you motivate yourself to know that someday I will definitely achieve success, and my process is building up, I'm learning from my mistakes. So how do you motivate yourself? Because a lot of people who enter the markets get demotivated for a 1 or 2 year where the market is not supporting, or maybe they took some long trades or wrong investments, and then they get disheartened and they leave the market. So how did you motivate yourself, and what would be your advice to those who believe the markets?
Yeah, so exactly what you said. So my actual journey of investing, like proper investing, started at like the end of the bull market of 2017. So not also in the bull market. So I haven't seen the 2017 bull market properly, but I've seen the fall, of course. So I've seen the mid caps falling like tremendously in 2017, 18, 19. Large caps were increasing, but being a small cap and mid cap investor, I saw the fall, like drastic fall. And then saw the March fall, and now the rise after that. But yes, so the thing is, the first company which I bought, it also fell. So I was like, what went wrong in this? Like, where am I going wrong? Like, what am I missing? So that intrigued me more. So like, instead of demotivating me, it motivated me more to go like actually take it up as a career or something like that. Equities. Like it intrigued me, like what is the process, like how can I get multi-baggers? So like I have read about Rakesh Jhunjhunwala, Buffett and all, so like how do they get multi-baggers? So I went through the process. So I read books. So the thing is, theory is one side, practical is other side. So after, though we read all the books, we read Intelligent Investor, One Upon Wall Street, but unless and until we have our foot in the market, if once we invest the capital in markets, we won't get the experience, we won't actually know. So yes, the journey began in late 2017. So when markets fell tremendously, when all the companies, small caps, mid caps, like fell tremendously. So I didn't have much profit. I didn't have much gains in 2017 as well as in 2018. So then I started to invest in some very quality businesses and market leaders, in businesses which generated good cash, where promoters were good. And yes.
Okay, great. So of course, it was a time building process. You understood, you took the failures of 2017, maybe when the small cap, mid caps crashed, and you learned from them, and then you build up the process to maybe invest in the top companies, which were the leaders of the market. So Keval, one last question for you before I give you the floor to present yourself. It's a very, very important question, which I tend to ask most of the speakers is, so how did you turn yourself from being a trader, maybe because a lot of people, a lot of youngsters always are fascinating towards trading. Aaj lenge, kal bech denge, intraday karenge, I'll be doing futures and options, which is very fascinating at such a young age, because that is something which all the young investors and all the young people which I interact to like कि भैया मुझे तो derivatives पसंद है, मुझे तो intraday पसंद है. So how did you turn yourself from a trader mindset to investor mindset? Because starting में वो भी आपको you would have seen people making money in trading, and you would have got fascinated towards it. So how did you change your mind or maybe thought process so that it would help others to do that as same? Because trading is something which is not important, not the only thing. Of course, investing is important as well. So what are your thoughts on that?
Yeah, so trading, of course, in future options is very fascinating. Like it was for me as it was for everyone else. So, but the thing is, I was very clear until and unless I study deep into, until and unless I study trading, I study future and options, I won't invest in that, because I have a few family members. I know a few people who have lost like tons of money, who've lost their entire wealth on this trading in future and options without study. Of course, once you study, then of course you can trade on futures, options. It's a huge, like it's one of the best business. So like it has the highest return on capital employed, right? If you take leverage, if you trade on future and options, but only if you have deep study, if you have like experience of like 5 to 10 years of investing, of trading, then only future and options is meant for you. But otherwise, I don't think so. It's meant, as it says, it takes like 3 years to clear CA exam. It takes 4 years to become a pilot, but it only takes a demat account to become a trader. So Yeah.
Great, great. I think that was a great sentence which you used, that it takes for 4 years to being a pilot and 3 years to become a CA, and of course for 5 years for becoming a doctor. So
Yeah.
of course for becoming a trader or maybe a prudent investor, you need time. You need to give time. You need to give that thought process, that knowledge you should gain, and then only you can start doing all these. And the one thing which I like, again, I support you all that derivatives is something which is good, the best ROE, but the best ROC, but of course it requires a lot of experience, knowledge, proper risk management, which is very, very important. So if anyone is trading in derivatives, you should always have that proper knowledge, the proper capital. Otherwise, no capital, no capital markets. And if you don't have proper knowledge, the capital won't be left. So great, Keval. It was great interacting with you in terms of knowing you. How did you start? How did you go about it? And how did you convince your parents to come into this? So now, of course,
One small thing. Even my mom is not properly convinced right now, also. So yeah, yeah.
of course, that happens. That happens. Of course, I think she would be very happy and should be convinced from tomorrow after seeing your interview to over here. Great, great, great. So, so now the floor, I'll give you the floor to you to present the wonderful topic which you have for today, that investing in equities, the private equity way. And I think the whole audience is really excited to listen to you and the presentation and the way you'll be explaining it through practical examples. So even I'm also very excited to learn. So all over to you, Keval. You can start with that.
Sure.
And what I request everyone, you can, if you have any specific questions while he's presenting, you can drop it in the chat box. And of course, at the end, we'll have the Q&A session as well.
So am I allowed to share the screen right now? Yeah.
Yes, you can share it.
One sec. Yeah. So investing in equities, the PE way. So actually, I'm not going to talk about how private equity investors invest or something like that. But the main reason of taking this topic is to have a private equity mindset while investing in equities. So it's very important to have a proper mindset and proper knowledge while investing in equities. And we should be clear, like, what is the main purpose of investing in equities? And for that, I guess having a private equity mindset is very important. So yeah. So this is the main topic. Let's move ahead. So standard disclaimer that I'm not a SEBI registered advisor. So all the companies that are discussed during the presentation are just for knowledge purpose and not any recommendation. I might have invested in quite a few companies that are discussed today. So the private equity way. So what's actually the private equity way? Let's see. So the first thing is to invest in a business. So while we are investing in equities, we are actually investing in a business. So underlying business. So the thing is, stock price will eventually follow the business. So until and unless business will grow, the stock price won't grow to an extent in long term. So the first thing is to take investment decision purely after analyzing and understanding the business. So please, let's make the session interactive. So can you guess the company which is there, which I've taken the example of in this chart? It's a very famous company in this time, so most of you will know. So just write in the chat box, which is the company over here.
So everyone can write it in the chat box and I can help you, Keval.
Yeah, so most of you would know the company which I've taken over here, the example.
Wipro, Yes Bank. Okay, Yes Bank.
Yeah.
I think most of them Vodafone Idea.
Yeah, so it's
DHFL,
Yes Bank, right?
Yes Bank.
Yeah.
Most of them got it right, I think.
So the thesis behind, so what went wrong over here? So Yes Bank was at 393 in August of 2018, and then it fell to around 200, then 100 levels, and right now it is at around 13 to 14 rupees. So what we do is, when it went from 393 to 200, let's say, people would be like, most of people would be, let's invest at 200. Like, how much more could it fall? It's Yes Bank at the end, like went to 393 from 50 levels. So it will go back to from 393 to 700, 800 or something like that. So seeing that fall and just seeing the price, people start investing. But what we should do, what I would do is just look at the business, like why was this fall why has this fall happened at the end? So if we dig deep, then we would understand that there's something wrong in the business because of which the prices fall. And after seeing that, we won't like invest at least in yes bank at that time at 200. Let's say from 200 it fell to 100 levels. So at 100 levels, people would be like, it can't fall more than 100. It's yes bank at the end. But without analyzing the business, without understanding the business, they would invest in a company and then they would just bury their pockets. So yes, so this is the mistake which we make, and what actually we should do is this. So this is a company which I'll tell you later which it is, but if we see in March of 2009, the sales of this company was 225 crores. It grew to 339 in March of 2010, and in 2011 it was 492 crores, right? And the net profit was 32 crores in March of 2009, which is 59 crores in March of 2011. So net profit grew by 100% in 2 years. So at least we have to see this company like a company growing at 50% a year, a sales growing at around 30-40% CAGR. So at least we should look at this company. We should go into the fundamental analysis of this company. Like something's happening in the company, definitely, that they have grown at this pace. So then we should, so this is the first step, right? After seeing the financials, it's not like just seeing this, we would invest in the company. So this is the first step to look into this, into the company, any company. So this makes it lucrative. So we should go into this company. After going into this company, we would see that this is Page Industries at the end. So we know this, that Page Industries from 2012 at 2,500 rupees went to around 35,000 in mid of 2018. So yes, so if we invest on basis of fundamentals, as we see over here, 3 years, March 2009, 2010, 2011, and even though after this, if we invest in 2012, we would have created around 10 to 11 times wealth in around 5 to 6 years, right? So this is the power of understanding the business, analyzing the business, and knowing like where the company is heading towards, instead of just investing on the basis of stock price. The second important point which we should focus on is scuttlebutt. So scuttlebutt is basically knowing the products of the company before investing into it. So let's say I'm investing into an ice cream company and I haven't tasted the ice cream of the company which the company is manufacturing. So that doesn't make sense, right? So I'm investing in an ice cream company, and if I don't know how the ice cream tastes, what if it is not good for the market? What if ice cream doesn't taste good? So like, then it doesn't make sense to invest in a company. So importance of scuttlebutt is very much. So we should start with meeting the customers. So let's say the company is Sera, right? So Sera is manufacturer of vitrified tiles. So meeting the customers. So what do customers feel about the product of the company? After meeting the customers, taking their reviews, knowing their points, we should meet. I meet the suppliers and distributors of the company. So suppliers and distributors are the ones who know the actual demand of the company, what's happening in the company, how is the distribution set up, how are they planning to grow, because distributors are the one who takes them to the retail customers, right? So after meeting the suppliers, distributors, knowing their issues, knowing good things about the company, I visit the plant of the company. So visiting the plant, you also meet the employees. So this is like one of the major factors which I think, meeting the employees of the company. So employees are the one who actually knows what's happening inside the company, because they are the ones who are taking the company to the next level. They are the ones who are manufacturing the product for the company. So let's take an example. So recently I visited a company and I met the factory manager of the company. So factory manager was the one who told me what was going on in the company, how is the export demand. So as we know that Q2 was great for some companies, right? So I met the management. I visited the company before the Q2 results. So while meeting the company, while meeting the employees, the factory manager told me that they are having huge demands from the export side, right? So I could analyze that something good is going on right now. They are having huge demands from export. Might be due to lockdown, the pent up demand, but yeah, they would have good Q2. I predicted, yeah. And after meeting the employees, finally meeting the management. So meeting the management is as important as meeting the employees, because management is the one who is going to run the company at the end. So let's say we've invested into a sunrise sector, but what if the management is not motivated? what if management doesn't want to grow? So like our company, our investment won't grow if the management doesn't want to grow the business. So it is very important to meet the management, know the management, know the vision of the management. So at the end, I would say that the vision of the investor and vision of the management should meet. So if we have some vision for the company, like let's say I've invested in a company, I think that company would grow 10x, 20x because the sector is performing very well. It is a sunrise sector. But what if the management of that company doesn't want to grow? What if the management of the company is satisfied with the current business? So what if the management doesn't want to take the company to 10x? So then it doesn't justify my investment thesis, right? So it is very important to meet the management and know actually what's happening in the company and where the company is headed. So yes, scuttlebutt is very important, and these are the 5 factors which you need to take care of while investing. The other point is wealth creation. So our focus while investing should be wealth creation and not just to make like 5, 10, 20% of profits, right? Because we are investing our wealth, we are investing our savings. So it should be for a big purpose. It should be to create big money. And wealth creation is only possible if we have a good earning visibility of a company. If we know that company has a huge size of opportunity. Let's take an example, like a company having revenues of 500 crores and the market size of that industry itself is 1,000 crores. So company can't grow more than 1,000 crores because the market size of the industry is 1,000 crores. So it's only some growth potential left for the company. And if company can't grow, then of course our investment won't grow. So it is necessary to know that the businesses which we invest into have huge size of opportunity. So the first example which I have taken over here, like anyone take a wild guess and guess the company which it is. It's a MNC, just to give a hint. And this is a product which everyone of us have used like once in our lifetime at least. Anyone write in the chat box and Yesh Bhai can help me in knowing your answer.
Sure. So any guesses? Nestle, HUL?
So this is a MNC company. We have used this product in day-to-day lives. We use it every day.
Okay, I think now Keval has made it very easy. Now we can get the Unilever. So we are getting some on people on Facebook also. Colgate, HUL, Colgate.
Yeah. So it's Colgate actually. So Colgate. So the story behind Colgate is we are not going to brush our teeth twice a day, right? So Colgate is penetrated in India and like people are not going to brush their teeth like 3 times or 4 times a day. So it can't grow much more, right? Because everyone is using Colgate or any toothpaste, right? So the thing is, it should have a huge size of opportunity. Let Colgate be a great company, great management, MNC having great return ratios, ROC of 50% plus, great cash flows. But when the company can't grow, our investment won't grow. And we have the example over here. So the sales of Colgate has compounded at 9% over last 10 years. In 5 years, it has compounded at 3% CAGR. In 3 years, at 4% CAGR, right? The profit has compounded at 7% CAGR over last 10 years, 5% at 8% over last 5 years, and 12% at last 3 years. And it is reflecting in the stock price very evidently. Like if the company won't grow, stock price won't grow. So stock price is merely compounded at 13% CAGR at last 10 years, though it's not bad for like investors who do not want to risk their investment much. It's fine, but yeah. Over the last 5 years, the company has only compounded at 10% CAGR. Whereas the next company which I've taken is a specialty chemical company. So as we know, specialty chemical is a sunrise sector, huge size of opportunity, China substitution. So this company which I've mentioned has grown at 17% CAGR over last 10 years and 26% CAGR over last 3 years. So this is huge. So a company growing at 26% CAGR over last 3 years is huge, and which of course will be reflected in stock price, and which we can see over here. The company is compounding at 55% CAGR over last 10 years. So that is huge. So that would be vast for wealth creation.
I think your screen, the slide is not changed.
Is the slide changed?
It's still showing the wealth creation.
Yeah.
Now it's changed.
Yeah. So I'll just explain through the figures over here, which I mentioned over here. I'll just explain the stock price growth. Can you see the stock price CAGR?
Yeah, now we can know it's again the wealth creation page which has come up.
Yeah, I'll explain the stock price CAGR in the wealth creation page, and then I'll move forward.
Sure, sure. Yeah, we can see that.
Yeah. So as I said that the sales should grow. The company should have a huge size of opportunity for growth, right? So over here we can see that company has grown at 26% CAGR over last 3 years, and this is reflected in the stock price. The stock price has grown by 80% CAGR over last 3 years. So it's not 80% growth over 3 years; it's 80% CAGR. So 80% in first year, 80% above that, and 80% above that. So that's compounding at 80% over 3 years. So that's huge for investment. So how can we get sunrise sectors? So how can we know what are the tailwinds? So the first is that company has huge size of opportunity to grow. Second is that promoters aggressively increasing the stake. So this is a good sign. So if promoters are aggressively increasing the stake in the business, so that means that something is brewing in the business, that something interesting is happening, that promoters are increasing the stake. So this is not the only point on which I take investment decisions, or we should take investment decisions, but this is one of the factors that where we should look into the company for investing. The third point is smart money inflow. So smart money inflow is money of institutions. So where institutions are investing in the companies at a very early stage. So institutions have insider, like institutions know the management, meet the management, they have information like what's going on in the company. So if institutions are invested at very early levels, then that is a good sign to look into the company. And last point is capex. So company will only invest in their capacity, only will increase their capacity if they are seeing a huge demand coming up in the market. So if company is doing a capex, then that's a huge positive sign. The last point is odds should be in our favor. So catching the companies early in their cycle, it is very important. So to invest a sizable amount in the company, get a sizable stake, and the downside risk being low compared to the upside potential, we need to catch them early. We need to invest at good fair valuations. If we invest at fair valuations, then only we'll able to invest good amount and take a sizable stake in the company. Otherwise, we won't be able to get a sizable stake in the company. And the third point is make the most of the corrections and buy on dips. So as I mentioned, that if we know the management, if we know that where the company is heading, so when there are corrections, let's say the company fell by 20%, then it would be welcoming for us. We would invest more when company is corrected 20%. Instead of hesitating, and we might also exit our investment if we don't know the company, if we don't know where promoters are heading, if we don't understand the business. So it is very important to buy on dips, buy on corrections, if we know the company and if odds are in our favor. Now we'll go through some case studies. Yes, bhai, if you want to give any points over here before I take on case studies.
So yeah, great, Keval. I think it's going very good. Where the way you have explained the points, which is very very important for people to understand that. Of course, knowing the management, knowing how the company is doing, and knowing what the management commentary is, or maybe the promoter is increasing the stake in the company. So I think these are very very important, crucial points. I think which will help everyone to at least note down once they're investing next time in any company. They should at least know the scuttlebutt approach which you talked about, that how people should try to meet the customers, the people who are close to the company. When the company try to attend the con calls, which is very very important, where the management guides about the companies. So I think these are some very very relevant and important points. And I think after your case studies part, where you'll be explaining, I think the stocks, few of the stocks, I think that will be much more clearer. So that's great.
So now I'll be taking all the practical examples. These are all the investments which I've made. I might have been invested in some, I might have exited some. So please don't invest just on basis of my investment. Yeah. So the checklist. So this is very important. So for me, so many of you will know that big investors have some theory. So someone will have a smile, someone will have UGLP. This is my checklist. So before I invest in any company, I go through this checklist. So the first point is, do I understand the business? So it is very important for me to understand the business. So if I do not understand the business, I won't invest in a company. If I won't understand the business, of course, I'll try to understand it. If I don't, then I won't invest in a company. The second point is, do I want to own the business for next 5 to 10 years? It is very important to own a business for 5 to 10 years, unless there is some disruption. Why 5 to 10 years? Because there are business cycles. So a business might be in a down cycle, and to go through the down cycle and to come through the up cycle, you need some time. So 2 to 3 years at least for that, and to play the up cycle, you need next 2 to 3 years. So it would definitely take 5 to 10 years for your investment to give you great returns and for a good wealth creation. Third point is, does it have huge size of opportunity, which I mentioned in the previous slides, that it is very important for businesses to have huge size of opportunity. Then only they can grow and our investments will grow. The fourth point is, does business have tailwinds? So tailwind is quite important. So if a business has tailwinds, then it is very interesting for me. It would give them a good and clear pathway to grow. The fifth point is, can the business grow at 20% CAGR over the next 5 years? So if a business is growing at 20% CAGR over the next 5 years, and if it is fairly valued, then close your eyes and it's a great investment. But the thing is, it should grow at 20% CAGR over the next 5 years. The sixth point is, are the valuations favorable? So it is very important to have valuations favorable. If the valuations are not favorable, then you might have more downside risk than upside risk possible. And the last point is, and which is very important for me, is how can I lose my money on this business? So how can things go wrong? So before I invest in any companies, I write all the factors, like how can I lose my money? What things can go wrong in the business? After writing all the points, like how can I lose my money on this business, I try to get cleared with the management. I try to ask them on con calls, like the issues which I have, risks which I see in the business. After getting the clarity from the management, it would be clear for me also. I would get my investment thesis clear, and this would help me in buying on the corrections as well. So it is very important to note down points on how can you lose your money on this business and get it cleared from the management or the promoters while con call or meeting them or anyways. So this is the checklist. Now we'll move on to the case studies. So Newland Labs. So Newland Labs is a recent investment which I made in April. So I'll take you through the case study of Newland Labs. So Newland Labs was at high of 1500 levels. It fell to around 225 in March of 2020. And yes, I invested in on 9th April 20 at 347. So what was my investment thesis? So I was, this company was in my watch list since past 1 year. Since 2019, and the investment thesis which I had for Newland Labs was, the thing is, the price which fall from 1,500 to 225. So there were some business issues. So the business issues were the raw material prices. So the company was facing huge volatility in the raw material prices, and they couldn't forward that increase in raw material price to their customers. So this impacted their profitability and their margins, right? So if the margins of companies are affected, then the net profit would reduce, and then people hammered this company in the market. So the business was intact, just the raw material prices. So it was a matter of time that the management clears the volatility of raw material prices. So what the management did was, they started the backward integration. This means that the thing is, management tried to get the raw materials from India, from other countries other than China, and as well as manufacture themselves, so they won't have to face this issue again. So this was the first positive step which the company took. The second positive step which company took was, company was focused on 3 verticals: the generic side, the specialty side, and the API and the CREMS side. So the custom manufacturing and custom research and manufacturing services is very important. So this is a business which is low volumes and high margin business, and company was aggressively focusing on this business. So this meant that in long term, that the margins of company will increase exponentially and substantially, because company is focusing on businesses where it is going to give them high margins. So over here we can see from the P&L that in March of 2017 the revenue was 579 crores, and in March of 2018 the revenue fell down to 527 crores. Net profit fell from 47 crores to 12 crores, as the margins fall dramatically from 18% to 10% to 9%, right? So of course, as I say that stock price is always related to the business. So due to bad performance of the business, stock price fell from 1500 levels to 225. But then at 225, it was very interesting to invest in the company because valuations were favorable. Management was very much ready to focus on growth. They had a new capex, they had a unit which was ready and which could generate a good amount of revenue for them, and which they will generate in future. ROC. So the thing is, people focus on perfect financials. So people want ROC, which is above 30%, ROE, which is about 25%, right? But the thing is, we need to focus on growth of ROC. So here we can see that company had ROC of 4% in March of 2019 and a ROC of 8% in March of 2020. So this meant that company grew that return on capital employed by 100%. Though the return ratios were not perfect, but they grew by 100%. This means that something is going on in the company, right? Company growing at 100%, the return on capital employed means something interesting. So this made me look into the company. The negatives of the company, which market saw in the company, were low ROC, low ROEs, degrowth in sales, high PE, low promoter holding. But positives which I saw and I mentioned were the CREMS and the CDMO segment. So the revenue contribution of CDMO was 11% in 2015-16, which grew to 25% in 2020. The revenue which they generated from their CREMS business was 55 crores in 2015, which went to 188 crores in 2019. So they grew by around 3 times, right? So the revenue grew by 3 times, 27.53% CAGR. So the company was heading in the right way, and it was just a matter of time that the price will follow the action of the company. So yes, so eventually invested at 347 levels, and currently the company, the price the company is quoting is around 1,800. It went to 1,300 highs, but of course there are ups and downs in the company, but business is intact. And yes, so this was my investment thesis in Newland Labs. So the main thesis was buy damaged stocks but not damaged company. So if a company is damaged, then do not buy the company. But if stock is damaged, if stock price has fallen due to some factors which the company is going to work on, then of course buy the company at low valuations and you will be benefited a lot in long term. So the second case that second company I'm going to talk about is Apollo Tricoat. So this is a very interesting example. So in 2018, I read a book called Cancelim by William O'Neill. So William O'Neill is an investor in US who has written this book regarding Cancelim strategy. So I'll take you briefly through the Cancelim strategy. So what is this strategy? And it is very important. It is according to me a very good strategy for investing, which even I use. So C stands for current quarterly earnings. So quarterly earnings should grow by 20 to 25% quarter to quarter. The annual earnings should grow by 20% quarter to quarter. The N stands for new products, new service, or new management. S stands for supply or demand. L stands for leader. I stands for institutional sponsorship. And M stands for market direction. So if we see over here, the company was growing at more than 25% quarter to quarter. So the sales of company in March of 19 was 5 crores, which went to 52 crores and which went to 154 crores in September of 2019. This meant that company grew by around how many times? Around 300 times, around 30 times in like 2 quarters. So there is something interesting definitely happening in the company, that company grows by 30 times in 2 quarters. So that's not heard of generally. So I looked into the company. The net profit went from like making no profit. It made a profit of 4 crores, 9 crores, and then 18 crores. So this was something where I started looking at the company. The interesting thing which happened in the company was it got a new management. So the previous management exited, and the new management of Apollo Pipes, the management which has experience of over 20 years in the pipes business, they entered this company and renamed it Apollo Tricoat. So this made it interesting. And the N, which stands for new management, the new management came into the company and they just transformed the company. And this is related into the stock price. So in 2018, it was around 100 levels. In March 2020, it was at around 275 levels. And currently the price is quoting at around 795 levels, right? So just because of this canceling strategy, just because of some factors, this has resulted in the performance of the company. The third case is Alkyl Amines. So this is a specialty chemical company which I've invested into. So the triggers, the reasons why I have invested into these companies are, so the company is a duopoly. So the major players in India are only two: Alkyl Amines and other player called Balaji Amines. So only two players in India, just having the whole market of aliphatic amines, right? So that is great trigger. Management is very much focused, so they use their cash generated from the profit in very frugal way. Great use of cash generated from operations, constant increase in market share. So their market share was constantly increasing, and market was dominated by China, but due to environmental issues, China reduced the production of these chemicals, and it uh, impact and it was very much, it was a positive sign for Alkyl Amine, and they grew their market share to a substantial way. So the prudent use of cash flow, which I'm talking about here. So the profits generated from the company, which you can see over here, they generated profits from 23 crores to 266 crores in March of 2020, right? So how they have used this profit is very much important. So mainly they've used this profit in two ways. First is by buying fixed assets. So that is capex. So if a company does capex, so that means that they are investing into new facilities, and this means that they will generate more revenues in coming times. And the second is dividends. So company has paid dividends and company has invested in capex. So these are the two things where company has invested their profits generated from the operations. Other important thing is, though company was growing at great levels, though company was generating great cash flows, but company was not misusing their cash flows. Many companies misuse their cash flows. They venture into new businesses, or they just take their net profit with themselves and do not give to the shareholders. But this company was investing into capex and giving dividends to the shareholders. So this is a great sign for a company. So I invested at this levels, and then it grew to around 3,200 or something like that. So it is very important that if a company makes a good use of that cash generated from operations, then it's a great sign and it's investment worthy. The third example is IOL Chemicals. So this company I invested in April of 2020. I invested at around 256 rupees, and I have exited the business, but I exited at around 730 rupees in October of 2020. So in 3 months, I did exit the business. I'll give the reasons why I exited. So the reasons why I entered the business are, the positive triggers were, the company was available at a throwaway price. It was available at a PE of 3.3. 3.3 is nothing. So a good company available at a PE of 3.3 is amazing. The company had plans to become debt free by Q4 of FY20. The company had good Q on Q top line growth as well as bottom line growth in previous few quarters. Ibuprofen, which is the main API which company is manufacturing, the production of ibuprofen had paused in China. So this caused a demand supply gap, which benefited IOL, and the prices of ibuprofen increased exponentially, which benefited the revenue of IOL Chemicals, and the company had paid dividend for the first time to the shareholders. So these are the triggers which was a no-brainer for me to invest in this company. So if we look at the financials, which I was talking about of IOL Chemicals, in March of 2017, the revenue of company was 711 crores, right? The profit generated from the company was 5 crores, which went to 28 crores in March of 2019, and which is 237 crores in March of 2019, right? So this is like around 40 times growth in net profit generated. And after growing at this levels, the company was trading at levels of 3.3 P. So this is very interesting. If a company maximizing their profits by 40 times in 2 years, and then to trading at levels of 3.3 P, this makes no brainer to invest, because management was clean. They were paying dividends for the first time. They reduced their debt and they became debt free, as well as they were going to pay the dividends for the first time, which we can see over here, that dividend payout was the first time in March of 2020. So these were the triggers due to which I invested into IOL Chemicals in April of 2020 at 256 levels, and currently it is trading at around 700, though I exited at around 737 levels. The reason of my exit is also was important. The reason I exited, the company was mainly focusing on a single API called ibuprofen, right? So it is very risky for a business to focus on single API. So what if the prices are stagnant of ibuprofen? What if they do not rise, and what if they fall? So if the price of ibuprofen fall, then it would majorly impact the revenue of IOL Chemicals, and then the prices would reduce dramatically of the company. Other factor is in America, a company called BASF started their production. After BASF starting their ibuprofen production, according to me, the revenue of ibuprofen generated by IOL Chemicals in America would reduce. Due to that, they will be affected. Not saying that this is not a good company to invest, but according to me, it's a bit risky at current valuations, which as it is trading at a PE of 10. So I exited at 737 levels. This is called disruption, as I mentioned. So it got disrupted. Another company called BASF started a production of ibuprofen in America, and this got disrupted, and I exited the company. This is a very interesting company called Bilcon. This was like one of the initial companies which I invested into. This is a big mistake which I had made. The investment thesis of mine was wrong, and I'd like to share it with you all. So Bilcon went to around 1200 levels, and currently it is trading at around 400 rupees, right? So why this fall, and why did I invest then? So what my thesis for investment was that Bilcon fell from 1200 levels and it went to around 700, right? So I invested at around 500 odd level. So why did I invest at 500 odd level? I was like, Bilcon is a good company. Government is focusing on infrastructure, not focusing, but they were going to focus. So now Indian government focusing on infrastructure, right? Indian government focusing on anything. We shouldn't be reliable. We should just be reliable on company generating revenue. We shouldn't rely on government policies, which I made a huge mistake relying on. So I invested at around 600, 500, 400, and I averaged down, and currently it is trading at 400 levels. So this is a huge mistake which I made. Mistakes which I made in this. So catching a falling knife. So this is a big mistake. So catching a falling knife is a huge blunder that we can make, and we shouldn't make catching a falling knife a mistake. What is the reason behind that? So once the price of company starts falling, if there is a sufficient reason, if there is a problem in the business, then it will fall dramatically, and you'll start averaging down, but you won't start making profits because the prices will fall because the institutions and big investors are selling the company. Another problem in Bilcon was the fundamental problem that payment delays. So because of payment delays, the working capital of the company was too high. Company didn't get payments from the government, payments of the project that they completed, and because of that, they had to take huge amount of debt. Because of huge amount of debt, the ratios of the companies were impacted, the return on capital employed and all that. Because of that, the market hammered the company, but I faced downfall because of that. And the third point which I mentioned is heavily dependent on the government policies. So if a company in India is heavily dependent on government policy, then I think it's not a good investment, because policy of government can change anytime if the government changes, if the policy changes, something like that, right? So then company will be affected and our investment would go haywire. So never be dependent on government policies in India, at least. So yes, these were the case studies, and now I'll just go through some do's and don'ts which I have experienced. All these are practical do's and don'ts which I have focused on, and which I'll take care that I don't make these mistakes again. So I'd like to share this with all the other investors. The first thing is to always invest in a market leader. So be it a small cap company, mid cap company, or a large cap company, but always stick with the market leader. What does this mean? So let's say a business sector is 3 companies, a market leader, a second, and the laggard, right? So when there is a downfall, when there is an economic downturn, when there is a down cycle in the business, the market leader will capture all the share. They'll try to create pressure on the second and the third company, because market leader has cash. Market leader would try to grow in the adverse times, right? As we've seen that during COVID times, many companies have expanded. Many companies have taken over the small companies. Why? Because they were the market leaders. They had the cash with them to take on other companies and to be benefited because of this crisis, because of the economic downturn. So always stay with the market leader. Second is focused on businesses which are gaining market share. It is very important. So if our business is gaining market share, then only stick with them. If they are losing the market share to someone else, so then it does not make sense to be invested with them. Third is to focus on sunrise sectors. So this is very important. So if we focus on sunrise sector, then we get a tailwind, we get a good pathway to grow. So currently, if we talk about, then there are some sunrise sectors. So like, can you point out some sunrise sectors, guys, in the chat box? Yes, Bhaiya can tell me the sunrise sectors which audience.
Okay. So I think, yeah, I'm already started getting pharma, AMC, chemicals, pharma, dairy products, IT, tech,
Okay,
insurance,
so
AI,
I heard IT and tech, right? So
specialty
I think that
chemicals.
technology, AI, and machine learning is a sunrise sector, right? Huge growth potential, great businesses, machine learning, artificial intelligence is the way to go ahead. So we need to focus on companies which are working on artificial intelligence, which are focusing on machine learning. The second sector, which is sunrise for me, according to me, is telecom. And in telecom, especially the product companies, the companies which are focusing on 5G. So which companies are focusing on 5G? The companies which are going to bring the 5G network to India, going to work on infrastructure of 5G. So the cables companies which are going to set up the 5G infrastructure in India, that's a sunrise sector because India doesn't have 5G. And in coming years, India will have 5G and India needs 5G because data is very important right now. So if I don't have network connection for 2 minutes with me, I go crazy. I have issues, right? So I don't want my network to be delayed. I want network everywhere right now. So I guess telecom, 5G, telecom infrastructure, AI, machine learning, all these are sunrise sectors. So these are the sectors which we should focus on. And the fourth is invest in businesses with ethical promoters, having interest of minority shareholders. So if promoters are not ethical, then it does not make sense. Promoters should have interest of minority shareholders. Promoters should take care of the minority shareholders. They would be willing to share the profits generated by them with minority shareholders. Then only our wealth would be, our wealth would grow, our wealth will be created. If promoters are not willing to share the net worth with minority shareholders, then we can't create wealth. We can't create a good amount of profit on our investments. And these are the don'ts which we should take care of. And these are the mistakes which personally I have. And I would recommend you all to take care of this. First is do not catch a falling knife. Never catch a falling knife. As I took the example of the Bilcon where I caught the falling knife. Second is don't invest on basis of presumptions. Never invest on basis of presumptions. Let's say that a company is going to expand to this place, going to have a turnover of 5,000 crores. No, let the company say, let the promoters say, let them give you the vision. Let you be convinced before just presuming anything. Talk with the management, then only invest in a company. Never presume and invest. Get your facts checked. Third is invest on basis of don't invest on basis of news or rumors. So this is like very harmful. So we get news or rumors that this company is going to focus on this, or they got this order, they got that order. Company rises by 3% next day and then it falls, something like that. So never invest on basis of rumors. Our purpose is to create wealth and not just have 5 to 10% of profits, right? So this does not help in wealth creation. Investing on basis of news or rumors. Fourth is don't invest in sunset sectors. So this is very important. So if we invest in sunset sectors, we do not get that growth opportunity. We do not see that path of growth in the business. And if business does not grow, then our stock prices, our investment won't grow. Fifth is do not invest in companies which are heavily dependent on government policies. As I said, that investing in government businesses which are dependent on government policies in India is quite risky, and we shouldn't invest on basis of that. So yes, these are the don'ts which I think, the mistakes which I have made, and I think that make mistakes, but do not repeat the same mistake again. If we repeat the same mistake again, then we could face huge amount of turmoil in our investment journey. So the thing is, I have an Excel sheet of all the mistakes I've made in the companies, right? So before investing in any companies, I go through all the mistakes, and I do see that are there any of these mistakes which I can make again in this investment? If there are the existing mistakes I've made, then I do not invest in the company. New mistakes are welcomed, and I'll always learn from the new mistakes which I make in my investment. but never making the same mistake again. Thank you. So yes, this was my presentation.
Great, Keval. I think now you can stop your screen, and I think there were a lot of plethora of questions which were there on the chat box, but I didn't want to stop your or stop your presentation and the flow which you're in. I think that was amazing. First of all, congratulations. I think it was an amazing presentation. The way you presented, first of all, the thesis, and then you explained it through practical examples, practical case studies. So I think that was really amazing and really commendable. The way you actually took the case studies, the way you explained one by one, how did you pick up the stocks, why did you enter, why did you exit, what was your strategy in it, and the do's and don'ts. I think that would be a lot of help for the people, because that summary would help them to analyze any stock, or maybe not lose money in the stocks, which are maybe try to enter only those kind of stocks which are matching those criteria. So great, Keval. I think that was an amazing presentation. It was great learning for me as well, because I always learn from the speakers who come, and I think the audience enjoyed a lot. So now I think it's time for Q&A, because a lot of people were asking a lot of questions. So now you can put them on the chat box, and I think we're getting great feedbacks for your presentation. So congratulations once again, and so let's open the floor for questions, because I'll just read down a few of the questions which were there in the mid, which I think we didn't answer.
Yes, so I can see quite a few questions on Zelpmog and
there were quite a few questions. So I think let's start for the first one, which I was there. Which are the companies which one need to look at the AI space? I think this is company specific. Okay. So how do you do your stock selection among so many stocks? How do you start with your stock selection among so many stocks listed in the space? So, yes, so I think he's asking about how do you do your stock selection study?
Yes, so as I shared the checklist ahead. So in the checklist, most of the companies are filtered not investing, right? So the first thing is understanding the business. So not necessarily we understand all the businesses. So try to avoid investing in businesses which you don't understand. So if you invest in a business which you don't understand, then you will not able to sustain the whole journey. You won't be able to ride the whole journey. So if there is a fall, if there is a correction, then you will exit the business and not invest more. So if you understand the business, then you will be able to invest more during the dips and the correction. So try investing in businesses which you understand.
Okay. So second question, I think it's a very important question also. How do you assess the quality of the management?
Yes. So management taking care of the minority shareholders, as well as prudent, as well as how they are using the cash generated from the business. So that is very important. Where are they using the cash?
Great. There's one more question. We as individual investors won't be entertained by the management. So how do we get to meet them?
Yeah, so you can also attend the con calls. So many companies also conduct con calls. So you can attend the con calls, talk with the management, ask your question, also interact, also know the questions which other investors are going to ask to the management. So yes, if one can't meet the management, then this is the way.
Okay. So is technical analysis important for all the entry and exit points for long-term investment? Someone has asked.
So technical analysis is definitely important, but I have one thesis. So let's say you are going to invest for 5 to 10 years, and you are going to invest where a company can give you a multi-bagger return, right? So 5 to 10% of the entry of up or down won't affect much to your total return at the end of your investment journey, right? So it's important to know the entry points, but yeah, technical. But I invest on basis of long term in fundamental analysis only.
Great. So we will take 3 more questions, because already I think we have Keval has answered in a very beautiful way. about how to go about it. So how many companies do you hold usually at a time? How is the allocation at the time of investing? And uh, uh, when a few stocks outgrows your portfolio returns? So I think that's the last one is irrelevant, but the first two questions. Yeah.
So I try to have a concentrated portfolio, but the main thing is a company does not exceed 10% of the portfolio until and unless I have met the management. I'm very clear about the vision of the management and I'm very clear about the direction where the company is heading. So if I am very clear, if I'm very confident, then too my investment thesis can be wrong, of course, but then I go about 10%. Otherwise, it's maximum 10%. And right now I might be having around 5 companies where I'm heavily invested in, other 5 to 10 companies which are a sizable quantity just to keep on a watch list.
Great. I think there's one question on Facebook that how do you assess the cancel strategy in a stock? Like, is there any website or something, or do you do it manually?
We have to do it manually. Cancel strategy, we have to do it manually. So you can do it like look at the financials of the company, quarter on quarter earnings. So if the quarter on quarter earnings grow by 20%, so that's the first indicator. Second indicator is year on year earnings. So if it grows by 20%, so that's the second indicator. Go through the annual report, see if the management is, see if they're coming up with the new products or if there is a change in management or something like that. So that's the third factor. But I guess you will have to do it yourself.
Okay, I think there are a few questions, a few people asking about how to attend con calls. I think you can attend it. The company uploads it on the
Yeah.
BSC's website about the details of the con call. So I think you can do that. So I think one last question which is there on Facebook I'll take, that is what is the importance of debt equity ratio and promoters pledge while seeing the fundamentals of a company?
So they are talking about debt to equity ratio, right?
Yeah, debt to equity and promoters pledge.
Yeah, so company should have a company shouldn't have a higher debt to equity ratio. Of course, I do not like companies having good debt, high debt to equity ratio. And the second is I try to avoid companies where promoters have pledged until and unless I know the reason why promoters have pledged and I know the vision of theirs. Not necessarily all the companies having pledged promoters shares pledged are bad companies or not a good investment, but you should dig deep if promoters shares are pledged.
True, true, true. Great.
Yeah.
I think we have already
But it's
answered
not
a
a
lot of
bad sign.
questions.
Like it's not always bad if promoter shares are pledged. There might be some reasons, so you need to know them.
Of course, we need to get
Yeah.
deep into it about why the promoters pledged and why it has happened.
Yeah.
So I think Keval has answered most of the questions. Still, if you have any questions, Keval is really active on social media. You can contact him on the social media sites,
Yeah.
like Twitter, and he'll be happy to answer you. So once again, thank you so much, Keval, for your time, for your wonderful presentation. I think it was some amazing learning for all our audience, and I think they really liked it. So once again, thank you so much, Keval, for being there on a Sunday evening, for teaching people how to invest in the right way, in the private equity way. And I think today, even your mom will be more confident to you the way you have presented. So that would be there.
Hopefully.
Some closing remarks from you, Keval, before please.
Thank you everyone for attending the interview, the webinar. Yes, I hope we have a great investment journey. You guys have a great investment journey ahead. Focus on long-term wealth creation. Don't focus on, if you are a long-term investor, do not focus on 10 to 20% of profits. They are minimal. Focus on long-term wealth creation. Understand the business and then only invest. Don't invest without understanding a business. Dig deep, which is very important. The thing is, the last thing which I would like to say is investment is, treat investment like a business. Like treat it like a business. Do not just invest just on basis of stock price or rumors or just something which you have seen in television.
Great, great, Keval. So some great insights, some great wisdom sharing, and I think the audience would have learned a lot today. And from tomorrow, maybe that will help them a lot in building their portfolio and maybe changing their thesis of how they do their investments. So once again, thank you so much, everyone, for joining on a Sunday evening. I think the audience is the ones which motivates me to call people like Keval who share the knowledge, and for being there till the end. I think still we have more than 70-75 people on Zoom, and we have more than 25-30 people on Facebook who are live, who are attending it throughout the whole session. on a Sunday evening. So that's really nice of you all. Keep showering your feedbacks and your love to us, so that it motivates us to do more well, and to once again bring Keval on our platform to share another topic and another knowledgeable webinar. So that's all from today. But again, next week we'll have another great speaker, another young speaker who will be sharing his knowledge, his wisdom, his sharing in the markets. Till then, have a great trading and investing week ahead. Keep joining our knowledge groups, where we share a lot of data, a lot of analysis free of cost, because as our motto is to spread knowledge and keep learning, keep sharing. And soon this video will also be uploaded on our YouTube channel, where we have already uploaded more than 20-25 videos, which are full of great knowledge, full of great people who have come to our platform and spoken about some great topics. So do watch them, and soon this will also be uploaded. And of course, follow the process, follow the right mindset, do your proper due diligence before you invest, and have that list ready before you invest in a company or maybe trade. So this is all from my side today. Yash Tugar signing off from now, but I'll see you all next week. Till then, have a great trading as well as investing week ahead. Take care of yourself, take care of your family, and spend more time with them, and spend more time on your portfolio as well.
Thank you everyone for joining the webinar. I hope you guys stay safe, and my best wishes to everyone. Thank you.
Absolutely. Thank you so much, Keval. Thank you all audience.
Thank you,
take care, and I'll see you all next week. Till then, bye bye. Take care.